Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alaska Air Group Inc. Annual Report. Alaska Air Group Inc. operates airlines through its subsidiaries, offering various services to meet diverse customer needs. The company's primary business involves providing scheduled air transportation for passengers and cargo across the United States, Canada, Mexico, Costa Rica, Belize, Guatemala, and the Bahamas. The company operates three main segments: Alaska Airlines, Hawaiian Airlines, and Regional. These segments cater to different markets and customer requirements, ensuring a comprehensive range of services. The airline offers flights on Boeing jet aircraft for both short-haul and long-haul routes, making it a convenient option for travelers. In addition to passenger transportation, the company also provides cargo services, further expanding its reach and capabilities. With a rich history dating back to 1932, Alaska Air Group, Inc. has established itself as a reliable and efficient airline operator, serving various regions across North America. Alaska Air Group, Inc.'s stock price has experienced significant drops over the past year, with a decline of -26.47%. The main causes of this decline can be attributed to two major events: an IT disruption in November 2025 and lower-than-expected earnings in April 2025. The IT disruption in November 2025 had a severe impact on the company's stock price, causing it to reach its 52-week low of $37.63 on November 20, 2025. The disruption led to a major technology outage that grounded flights across the United States and resulted in downtime on the airline's website and mobile app. In April 2025, Alaska Air Group's shares fell by as much as 8.1%, following the announcement of its first quarter 2025 financial results. The decline was attributed to earnings per share falling short of analysts' expectations for the quarter. Furthermore, management withdrew its 2025 guidance due to economic uncertainties. The combination of these two events has led to a significant decline in Alaska Air Group's stock price over the past year. Despite a surge in revenue for CONE 2025 due to the Hawaiian Holdings merger, profitability was negatively impacted by increased operating costs and integration expenses. Alaska Air Group, Inc. market capitalization of $6 billion is materially smaller than most of its industry peers of roughly $9 billion. Alaska Air Group, Inc. trades at a higher price-to-earnings ratio of 67 times and a lower price-to-book ratio of 1.56 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 78% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. Passenger ticket sales have been a consistent driver of revenue growth, increasing by $1.836 billion from 2023 to 2024, and by $1.836 billion from 2024 to 2025. Loyalty program revenue has also contributed significantly to revenue growth, with increases of $347 million from 2023 to 2024 and $247 million from 2024 to 2025. In contrast, cargo services revenue experienced a decline of -$146 million from 2024 to 2025. Segment-specific drivers also played a role in revenue growth or decline. For example, Alaska Airlines saw significant increases in passenger ticket sales and loyalty program other revenue, while Hawaiian Airlines experienced fluctuations in these areas. Regional carriers also showed varying trends, with some experiencing revenue growth and others facing declines. Other factors such as employee incentive pay plans and defined contribution plans have contributed to revenue decline, while capital expenditures have increased for certain airlines. Overall, passenger ticket sales and loyalty program revenue have been key drivers of revenue growth, while cargo services revenue and other expenses have driven revenue decline in some cases. Net income experienced a significant increase in 2024, rising from $235 million in 2023 to $395 million. However, this trend reversed in 2025, with net income decreasing to $100 million. The decline was attributed to various factors, including interest rate fluctuations and other external influences. Profit margins also underwent changes during the period. In 2024, net margin stood at 3.37%, while operating margin reached 4.88%. However, in 2025, these figures fluctuated across different pages, with some showing a decline to as low as 1% for net margin and 2.13% for operating margin. The reasons behind the changes in net income and profit margins were multifaceted. Seasonality and pricing initiatives played a role, while labor costs, fuel prices, foreign currency exchange rates, and other factors also contributed to the fluctuations. The company's financial performance indicates a stable trend in generating positive operating cash flow. Despite a slight decrease from $1.5 billion in 2024 to $1.2 billion in 2025, the operating cash flows remain positive. This is further supported by the net cash provided by operating activities of $1,249 million for 2025, which is also a positive indicator. The increase in depreciation and amortization expenses from $4,548 million in 2024 to $4,945 million in 2025 may seem counterintuitive, but it actually contributes to the company's positive operating cash flow. This is because these non-cash expenses are added back to net income when calculating operating cash flows, resulting in a higher positive figure. Overall, the data suggests that the company continues to generate significant positive operating cash flow, despite some fluctuations in specific metrics. The company's debt level has experienced a significant increase over the past 2 years. According to the financial reports, the total debt rose from $4,933 million in 2023 to $5,309 million in 2025, representing an increase of $376 million. This growth can be attributed to the acquisition of Hawaiian Holdings, Inc., in 2024, which contributed to the rise in debt levels. In terms of interest expenses, there has been a notable change as well. The company's net interest expenses have increased from $105 million in 2023 to $148 million in 2024, and further rose to $223 million in 2025. This significant increase can be attributed to interest rate swaps that fixed variable rate debt agreements, leading to higher interest expenses. Additionally, the interest expense for debt obligations increased by more than $300 million in 2025 compared to the primary use of operating cash flow. The airline industry has experienced mixed results across various segments and regions. On the positive side, passenger revenue has seen a notable increase, with 47 million revenue passengers in 2025, up from 39 million in 2024. Regional operations have also shown growth, with 11 million revenue passengers in 2025. The Pacific region has emerged as a strong performer, accounting for 6% of Alaska and Hawaiian passenger capacity in 2025, a significant increase from 2% in 2024. Domestic markets have also seen an improvement, with a 3% increase in total operating revenue. Latin America and the Pacific regions have experienced substantial growth, with increases in revenue per mile, RPMS, and available seat miles, ASMS. The Pacific region saw a $630 million increase, while Latin America recorded a $754 million increase. However, not all regions have performed well. Cargo and other revenue has declined by 4% in 2025, down from 3% in the previous 2 years. The Latin America region has also seen a decline, with its share of Alaska and Hawaiian passenger capacity decreasing to 6% in 2025 from 7% in 2024. Furthermore, certain regions have struggled due to increased competition. The West Coast and Hawaiian markets have been particularly affected by significant capacity overlap with competitors, leading to poor performance. Overall, while some segments and regions have shown growth, others continue to face challenges in the airline industry. Management is optimistic about the company's outlook, projecting a capacity growth of 2–3% in the short term. The transition to a single passenger service system and the launch of new credit cards and rewards programs are expected to drive revenue growth. In the long term, the goal is to achieve net zero carbon emissions by 2050 through sustainable aviation fuels and investing in new technologies. The company's strategic initiatives focus on enhancing the guest experience with its Alaska Accelerate vision, which prioritizes safety, care, and performance. The integration of Hawaiian Airlines into Air Group will also bring about operational efficiencies and a unified loyalty program. To mitigate risks, management has implemented various hedging strategies, including derivative contracts, interest rate swaps, and foreign currency exchange hedges. Overall, the company's strategy is centered around growth, sustainability, and customer satisfaction. By investing in new technologies and initiatives, management aims to position the company for long-term success while managing potential risks and challenges. The company's financial activities for the year ended December 31, 2025, reveal some key points regarding its dividend payments and share buybacks. Notably, the company did not pay any cash dividends during this period. However, it did engage in significant share buyback activities. According to the data provided, the company bought back a substantial number of shares, totaling $679.8 billion. This indicates that the company chose to repurchase its own shares rather than distribute profits to shareholders through dividend payments. The specific amounts for each year are also mentioned, with $570 million in 2025 and $312 million in 2024. These figures suggest a consistent trend of share buybacks over the past 2 years. Concerns about inventory buildup and supply chain disruption are evident in various aspects of a company's operations. One potential issue is inventory buildup, which could be exacerbated by seasonal fluctuations in demand and financial results. The allowance for obsolescence of $86 million in 2025 also suggests that the company is anticipating some level of inventory buildup. Supply chain disruptions are another concern, particularly with the transition to a single passenger service system, PSS, and integration of Hawaiian Airlines into Alaska Air Group systems. This process may lead to vulnerabilities associated with vendor services, including potential for vendor bankruptcies, unionization, regulatory compliance issues, or significant changes in the competitive marketplace among suppliers. Furthermore, ongoing supply chain constraints could cause limited vendors to have performance problems, reduced or ceased operations, bankruptcies, workforce shortages, or other events causing them to be unable to fulfill their commitments. The company's reliance on partners for inventory and space may also decrease the attractiveness of the program if not met. These concerns highlight the need for careful management and mitigation strategies to prevent potential disruptions. That concludes the financial summary for Alaska Air Group Inc. Feel free to comment below, and I will be happy to answer them when possible.